The Senate is now finally on the precipice of passing major bipartisan infrastructure legislation.
Investors for past decade were basically pulling the wool over their own eyes on the capriciousness of the policy environment in China.
The risk of a tantrum this time is less because people understand the game plan.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. The push to taper. The Fed's Bostic and Rosengren call for a reduction in asset purchases as soon as autumn. The dollar holds again. Heading for a vote, President Biden's infrastructure bill goes to the Senate today. Democrats say they have bipartisan support. And we speak to the chief executive of the #1 crypto exchange in Europe, Jesse Powell of Kraken, joins us shortly. Now, in the meantime, this is what we're looking at on the markets. A lot of the focus, of course, is on bumper earnings. I was looking at some of the earnings figures. I have to say they're quite incredible. Now, whether that filters through the market is unclear because we've seen already market highs. But certainly what we need to look at is what we also heard from Fed officials as the markets need to try and understand what monitoring comments from Federal Reserve officials mean for their asset class if they start scaling back stimulus measures. Crude oil also bouncing back from a 3-week low on bets that the global demand recovery will probably remain intact despite this fast-spreading Delta virus variant. So let's get more on the markets from Bloomberg MLive editor Eddie Vanderwaal. I've already picked Eddie's brain on cryptocurrency and Bitcoin, but Eddie, if you look at the bumper reading in the U.S. jobs market, are markets now starting to price in an early taper from the Fed?
We saw a little bit of that volatility coming through, right? I think the market is right to start thinking about tapering this time and to do so early, because last time, 2013, when this was all new, there was, the market was very late in pricing tapering, and then we had a substantial reaction. So I think if we can see some of the market get ahead of this, and some people get their heads around the fact that this is not as unprecedented as it once was. Therefore, we know what the path out of this looks like. So I think the market is starting to come to grips with the fact that at some point, maybe not right now, maybe not by the end of the year, but at some point we are going to start seeing tapering.
Eddie, we also saw some gyrations in commodity markets yesterday with both gold and oil lower. Does this suggest that we could see tapering reverberate across assets?
Right. I think you're absolutely right, Francine. I think this is not going to be an event that is purely, confined to the bond markets this time. Because last time, 2013, the taper tantrum was primarily a bond market event, right? But this time around, I think there is so much of high asset prices are predicated on cheap money that we could see this reverberate as much across stocks as we do across commodities. And I think the commodities was for us, was a little bit of a precursor here. And remember, 2013 again, gold was the first asset class really to see that major sell-off, and it really showed the path for where bond for where bond yields was going to go. So I think we're going to see some of that, and I think commodity markets are a good place to watch at the moment.
So far, the smart move in equities, you were telling us, has been to buy any dips. Are stocks immune from this kind of volatility, Eddie?
That's difficult to say, isn't it? Because I think, we as investors have been conditioned to keep buying every single dip, and it's paid off. But I do think that this might be a little bit different. I think that, so much of particularly tech stocks and the non-dividend paying stocks are predicated, their asset prices are predicated on really low yields. So I think that there's a real risk that we see significant repricing. And it was interesting to see that this morning that SoftBank had got out of some of its biggest NASDAQ stars. I think the NASDAQ could be in trouble if we see sooner than expected tapering.
Eddie, I know you always make me smarter on Bitcoin, and you're my go-to person on, the killer questions for a lot of these Bitcoin experts coming on. So when you look at what Bitcoin, we've seen quite a lot of volatility as expected in some of these cryptocurrencies, but what happens in the next 3 to 4 months?
Yeah, it's so hard to call, isn't it? You're setting me up for failure there because, calling direction on Bitcoin is really hard. I'm quite optimistic about prices for a couple of reasons. We've seen a bounce back. We saw a major sell-off, and then we saw a bounce back, which traditionally in Bitcoin we haven't seen. Traditionally, Bitcoin had a run up, through 2017, and then for a number of months, even years, it sits in the doldrums. This time that was not the case. Bitcoin's come back a lot quicker. The second thing is that ETF that they're talking about in the US. If we see that come through, that could see a substantial amount of money coming into the space and really opening it up to the retail investors. So I think this could be a game changer. And I think for those reasons, it's hard not to be a little bit optimistic about Bitcoin at this moment in time.
Okay, Eddie, to be fair, I'm probably going to get hate mail on Twitter, but actually I feel like on Bitcoin and cryptocurrencies, whether you think it goes up or down, you're never wrong, because it kind of does a bit of both, often in the same day. Bloomberg M Live editor Eddie Vanderwaal there for wisdom on the markets. Now, stay with Surveillance Early Edition as we discuss crypto, the chief executive of one of the world's biggest cryptocurrencies exchanges. I've been looking forward to this interview all week. Jesse Powell of Kraken joins us next. And if you have any questions for him, just IB plus TV Go. This is Bloomberg.
Now, Mr. President, it may have taken all weekend, but the Senate is now finally on the precipice of passing major bipartisan infrastructure legislation. Last night, an overwhelming bipartisan majority of senators voted to surmount the final few procedural hurdles and put the bill on a glide path for passage tomorrow morning.
Well, that was the Senate Majority Leader Chuck Schumer. One of the losers ahead of today's vote is a cryptocurrency lobby. The industry failed to win a change to crypto tax reporting rules. The amendment it proposed would have addressed concerns that the bill requires crypto firms to report tax data to the IRS. They have said they don't have access to. Well, our next guest is Jesse Powell, and he's the chief executive of the digital currency exchange Kraken. In terms of trading volume, Kraken is actually Europe's largest and is the world's fourth largest. Outside the U.S., Kraken is popular because of its margin and futures trading offerings. Well, we're delighted to be joined by Jesse Powell, Kraken chief executive and co-founder. Jesse, as always, thank you so much for coming on. Every time you come on, actually, there's a big piece of news that we need to discuss. Today, it's the infrastructure bill. How much of a blow, what we heard yesterday, is it to the cryptocurrency industry?
Well, thanks for having me back. We still have a chance to save this, actually. So if we can get unanimous consent from the Senate in the morning here, we potentially could have a vote on this amendment. And there's just one holdout at the moment. It's Senator Shelby from Alabama. So if you're a cryptocurrency holder in Alabama, please give your senator a call and let them know what you think about this amendment. So what this amendment basically says, the bill says as it's written without the amendment, is that essentially everyone in the world, even computer software that's processing cryptocurrency transactions, would fall under the definition of a broker. And that means they would sort of be required to comply with all of the rules of a securities broker when they effectuate any kind of transaction, or if they are in any place in the process of a transaction, be them a person, a cryptocurrency node operator, a miner, or an actual broker like Kraken. And for us, it's not a big deal. It's not a change to what we're doing. We're already doing reporting. We're already getting subpoenaed by the IRS all the time for information. So for us, it's no big deal. It's really a big deal for the technology itself. This, right, as written, the bill effectively would be.
So Jesse, does it stifle innovation? I mean,
Absolutely.
What does it actually, does it stifle innovation, or does it, is it of more things to come that you're expecting to be regulated more and this is a first sign?
This bill as written without the amendment absolutely stifles innovation. I mean, it's effectively like saying every time you load a web page, you have to collect all of the personal information of the person visiting your website. It's totally insane, and it cannot be complied with as it's written. It just completely misunderstands the way the technology works. Obviously, decentralized protocols do not have a process to collect personal identifying information from people, or even have any way of knowing who the users are. So, it's a square peg in a round hole, and it's just kind of mind-blowing that at this point, 10 years on, the people in government would still have absolutely no idea what they're doing here, and without having any stakeholder engagement on this, would try to slide this into a must-pass massive infrastructure bill, as sort of a backdoor regulatory effort. It's just kind of shocking, and I think
Jesse,
makes everyone question the lawmaking process.
Yeah, but do you think they're just trying to make it safer? So even if it's impractical and actually impossible because you don't have the data, do you think it comes from a point of not trusting cryptocurrency or Bitcoin and just try to make sure that, they have as much data as possible to understand who's investing and how much?
I don't think it's about that. That kind of information is already available through the exchanges. We're regularly providing data to the U.S. regulators and to the IRS. And the stated purpose of this piece of the bill is to collect additional tax revenue. They believe that there are people out there engaged with cryptocurrencies that are not paying their taxes properly. And our view is that that's a very small piece of the cryptocurrency user base. Obviously, anything that you do through Kraken is easily reported to the IRS. Your transactions live on the blockchain for all time, and the IRS is actually very good at looking at the blockchain to see what's going on there. So I don't think it's about consumer protection. They say this is more about tax collection and paying for the infrastructure expenditures that are in this bill.
Cryptocurrencies have had a pretty wild ride, Jesse, over the summer. Do you think some of the run-up is actually in anticipation of Bitcoin ETFs?
These have been coming for years now. Everyone's been expecting every year that there would be an ETF launched. With Gensler in now, it's possible. They keep saying that they need to see the volatility of these markets be reduced. And I don't know if we're going to see that anytime soon in cryptocurrency. But there are other ways for people to get exposure to cryptocurrency. Obviously, an ETF would be fantastic for the industry. I think if anyone can make this happen, it would be under Gensler's watch. So we'll see, fingers crossed, but I'm not really holding out hope for this.
But if we do see ETFs or other exchange-traded proxies for crypto, does it make non-traditional platforms like Kraken redundant?
No. The ETFs themselves still have a requirement to hold the underlying asset. So they would have to go to exchanges like Kraken to acquire those coins. And then any users who actually have a practical use for the cryptocurrency, for example, if they're using Ethereum in smart contracts or in a DeFi application, or if they need to mint NFTs, they would have to actually have the physical asset. The ETF just gives you price exposure. It doesn't allow you to sort of interact with the blockchains themselves.
Do you see, on NFTs, do you see a world where you could actually list NFTs on Kraken?
Yeah, absolutely. We completely have the capability of doing that. It's more of a matter of creating an interface that makes it easy, because we're obviously just a crypto trading platform right now. We don't have a concept of a fungible token within the platform, but setting up some sort of e-commerce site within Kraken, I think, is something that is totally doable.
Jesse, if you look at the sell-off in Bitcoin, it does seem to have been more subdued than the past. Do you feel like cryptocurrencies is, I guess at the margin stabilizing? Is it becoming something that will, I don't know if it will plateau, but will just become up or down, but within ranges?
Yeah, we've seen historically Bitcoin move in these 4-year cycles, and every time it pops up 10x from where it was before. This cycle, if you look at the chart historically, we could easily go up to $400,000 a coin this cycle before we get to the next Bitcoin halving. So I think it will trade within a range for a while. We got up to $60,000. We went back down to 30. We're now hovering on 46. This is, just kind of par for the course if you look historically at the chart and these cycles. So I'm still very bullish on the price. I still think we could see hundreds of thousands of dollars a coin in the next 12 months.
Jesse, thank you so much for joining us. As always, Jesse Powell there with some pretty interesting thoughts. The Kraken chief executive joining us this morning. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. World leaders at this year's COP26 talks face mounting pressure to end the use of fossil fuels. That's after a UN-backed climate change report warned time is running out to stop global warming from exceeding 1.5 degrees from pre-industrial levels. Coal is a major sticking point, with India a key holdout against phasing out its use. Meanwhile, the UK says it will ease quarantine and travel rules to allow tens of thousands of officials to attend October's COP26 summit happening in Glasgow. Now, the US Delta wave that started in low vaccination states in the south has now engulfed the country, with cases and hospitalizations at their highest since February. 38 states have transmission levels considered high by the CDC, meaning they are posting at least 100 cases per 100,000 residents or have positivity rates of at least 10%. JPMorgan has raised the stakes in Wall Street's intensifying battle for talent, expanding a previously announced pay increase to include even more staff. A source says junior sales, trading and research analysts will now all get raises. Meanwhile, Jefferies is said to be matching Goldman Sachs by hiking junior pay to $110,000. Now that's up from $85,000. And UK retailers reported their slowest sales growth in 5 months during July as consumers shifted spending towards entertainment and social gatherings. According to the British Retail Consortium and KPMG, the volume of goods sold in shops and online grew 6.4% last month compared to the year before. The BRC also warned retailers are feeling the pinch. Now that's from Brexit, which is worsening staff shortages. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now let's also have a look at Tesla. Tesla shares are actually giving up some of their pre-market gain, and this is on some of the things that we heard from Tesla over the last couple of minutes. Tesla shipping 8,621 China-made cars in China. That is actually down 69% month on month. Coming up, SoftBank's Vision Fund reports a share drop in profit. Well, a sharp drop in profit, rather. That makes more sense. And China's tech crackdown sends the firm's Chinese portfolio into a tailspin. We discuss that next. This is Bloomberg.
Investors for past decade were basically pulling the wool over their own eyes on the capriciousness of the policy environment in China. So that's coming home now to bite a number of investors. But I mean, it's just one of many risks that you really need to take into account, but investors have not.
Well, that crackdown in China could also mean even more pain for Japanese conglomerate SoftBank. It's already reported a sharp drop in profit at its Vision Fund. The moves against tech firms by Beijing could actually hit the firm in the current quarter as well. Now, for more details, we're joined by Bloomberg opinion columnist Shuli Ren. Shuli, great to have you on the program. So what are your key takeaways from SoftBank's earnings?
The key takeaway is that SoftBank's March quarter is going to be a record profit quarter for a while, for perhaps quarters to come. What we saw was the June quarter was doing badly because the Vision Fund had to do mark-to-market accounting on a lot of its investment losses. Starting from Coupang, it recorded over $4 billion loss in Coupang, in mark-to-market, and as well as Uber. Going forward, by the way, that was earnings as of the end of June, but China's big tech crackdown really came in July. So going forward, it will have to do mark-to-market losses on Didi, which it reported a gain in the June quarter.
Shuli, you also think that the firm's earnings are becoming meaningless?
Absolutely, because when we look at SoftBank earnings, we just look at Vision Fund 1 and Vision Fund 2, right? And then a lot of them have we have real-time market data. Now we're already in August, but the earnings we're looking at June, the June numbers are almost meaningless. I mean, Didi is down over 30% from its IPO price, and a lot of other companies that SoftBank backed as well, like those Food Truck Alliance companies, their stocks are all down. The marketplace knows about SoftBank's portfolios a lot better than SoftBank itself, its accountants itself.
So, Shirley, what are the key challenges that SoftBank actually faces ahead?
Many. I mean, SoftBank somehow has to get the ARM deal done, right? And then SoftBank has to deal with the Didi and the China issue. I mean, Didi just raised $4.4 billion out of the U.S. markets. People are probably talking about take private, and what is SoftBank going to do about that? Like a quarter of its investments are in China. It has to be on good terms with Beijing.
Shirley, thank you so much. Bloomberg Opinion's Shirley Ren. This is Bloomberg. The push to taper the Fed's Bostic and Rosengren call for a reduction in asset purchases as soon as autumn the dollar holds again. Heading for a vote, President Biden's infrastructure bill goes to the Senate today. Democrats say they have bipartisan support. And raising the stakes, JPMorgan boosts pay for more staff, upping the ante in Wall Street's intensifying talent war. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, a lot of the focus on the markets is, of course, what we're seeing not only in earnings that beat a lot of estimates, but what we're hearing from Fed officials and asset prices trying to figure out whether they need to reprice some of the tapering expectations that, for example, Mr. Rosengren thinks could come as soon as the fall. Now, after struggling from months of closure during the pandemic, the hotel industry is pinning its hopes on a quick recovery. Intercontinental Hotels has reported a significant improvement, especially in the U.S. and China. IHG says that Europe remains its most challenged region. Well, the chief executive, Keith Barr, spoke to us this morning.
Increasing vaccination rates has led to travel restrictions being lifted, and that drove profit up 262% versus the previous year to $188 million. We made a decision not to pay an interim dividend because we still want to say how the recovery continues to progress, because we are still in the early phases of the recovery. Markets like the U.S. are doing quite well. China has been doing quite well, UK. But many parts of the world are still early days because of lower vaccination rates, too, so want to be measured about how we move forward. But we're really excited about the growth of this business. We opened 132 hotels in the first half of the year and signed more than one hotel a day, over 200 hotels in the first half. And in a few weeks' time, we'll be launching a new luxury and lifestyle collection brand too, so which will be the sixth brand we've added to the portfolio in the last 5 years. So really exciting growth. It's great to see people coming back into hotels, but we still have a ways to go before we're fully recovered.
Good morning, Keith. That first half growth sounds very impressive, very optimistic. I'm delighted to hear about it. Like Francine, I have not experienced a hotel for some time and would like to again soon. In 2020, you referred to the coronavirus as a short-term blip. Obviously, we've all had to frequently reevaluate how bad the pandemic will get. I'm curious on what your latest outlook for when the pandemic will no longer be relevant at all to your results. So, like, it might be a minor point, but it'll no longer be a major input. Do you think that'll be by the end of this year, by early next year? What is that outlook?
I think it's really going to correlate directly to vaccination rates and the lifting of travel restrictions. So if you look at the United States right now, very high vaccination rates. And actually, I was there 2 weeks ago. I flew from London to Atlanta to Salt Lake City and then Los Angeles. The planes were full. The front of the planes were full. The back of the planes were full. And not just with people on holiday. There were people like me with rollerboards and briefcases, too. And so you can see that travel is going to come back. But again, many other markets around the world have very low vaccination rates. And so there's travel restrictions. So I think we're going to see at least through this year and probably into time of next year, we'll see those restrictions still be in place. And so when those get lifted, again, you'll see people are desperate to travel. I mean, there is that demand and that hunger we see. I'll give you an example. We opened up in Spain, a resort recently, and when it was made approved to the UK, we booked €1 million of business in one day.
Well, that was the IHG Chief Executive Keith Barr speaking to us this morning, sticking with that theme. As the world gradually reopens, travelers are still hesitant before stepping on a plane again. But to do all that research yourself can be incredibly time-consuming, so we've made it easier for you with Bloomberg's Travel Reopening Tracker. You can find it on NI Big Take on Bloomberg.com. I have to say, it's pretty cool. You type, for example, I want to go from London to Milan, and it gives you, for example, a vaccination rate to Milan, and it tells you how difficult it is to get into the country and to go to cafes. I just got back from Italy, and it is absolutely spot on. Now, while the spread of the Delta variant has touched all aspects of the European economy, with access to stimulus and the health of businesses across the bloc firmly in focus. Joining us for a conversation about how that's playing out in terms of regulation is Carmine Di Noia. He's commissioner at Italy's stock market watchdog, Consob, but he's also one of the names listed as possible taking over ESMA. So Carmine, thank you so much, as always, for joining us. I know you've also done a lot of work on the trends for the markets and with the OECD, and we had a conversation on this in the last couple of weeks. Talk to me a little bit about the Capital Markets Union. We've been talking about it for quite some time. How do you think fintech and banks will actually change, and what do we need to, for this to adapt to the realities of tomorrow?
Capital Markets Union is a great project. The idea is to try to have more and more the possibility on both sides, demand and supply, to go over, national borders, the possibility for, companies, especially SMEs companies, growth companies, small one, not the typical large one who more easily go on the other market, raise capital on other exchanges and with international investors. So the possibility to have other access, but also the possibility, that's very important also, I'm very keen on this, for financial democracy, the possibility for investors, directly or indirectly, including retail investors, to invest, in other markets, with being careful of investor protection, transparency, and so on, but trying to diversify their portfolio. This is very important, especially, in this moment of very low, interest rates, for, investing for their future, the future of their sons, the future and their pension. So an important project. In order to do that, it's not, I always say Capital Markets Union, that is the S. It's not the idea of having a single stock exchange. It's very, very important that bottom up, all capital markets grow, because having better and, bigger capital markets in the EU27, especially after Brexit, is an important issue. Traditionally, we're very small bank oriented, but capital markets, we have seen also for COVID, are more, resilient when you have shocks. So that's a very important issue.
But so what has been the number one change post-COVID-19? Or we're still in the middle of COVID-19 with the resurgence of the Delta variant, but actually, has it changed the way you look at some of these things, some of the trends, but also concerns going forward?
Also, I was listening to the previous interview, even, in the EU, we are having, strong financial market performance, but still a lot of economic uncertainty. We're having, rebound, massive also plans. And so on the market, and especially equity markets, we have, I would say, spectacular evaluations. We are also a securities regulator, and ESMA is about also to issue its next TRV, but also Consob has just issued 2 days ago its report. We watch carefully to this possible, decoupling, of economic and financial market decoupling in terms of the true evaluation and what is on the market. And in this sense, capital markets are important in the project which are already on the pipeline of all the CMU action plan. For example, in terms of having a single point of access for information, would it be corporate information, would it be market information, are very important. In order to allow to raise capital outside your border and also to invest outside your border, you need information, comparable information, simple information, standardized. So, and this is the single point of access, for example, is a very important project for this.
Is there a policy that actually, and you were referring to the OECD report that also lays out some of the policies that you would be putting in place together with the fellow, of course, authors of this report. Is there a policy that policymakers and governments have failed to implement that you think will be crucial to the stability of financial markets going forward?
You know, the OECD report is very interesting. Released when it was 1 month ago, because sitting at the OECD Corporate Governance Committee, which I have the honor to co-chair, is we have all OECD countries, G20 countries, FSB. So it's very important. The thing is that good, corporate governance and efficient functioning of financial market is a key issue in general, and is a key issue even more for the recovery. Now, the report, after underlining, an issue, a structural issue of in the last 15 years, 30,000 companies left the market, and they were not, matched by new companies. Totally matched, especially these in US and Europe and Europe. Yes. So, okay, we are having, and you have discussed at Bloomberg many times, we're having in these first months of the year, the number of IPOs is even higher over the whole, 2020, but still we're very low. So important to have easier access, especially for SMEs to markets. So simplifying regulation, but also maybe supervisory, attitude, especially having a proportionate, approach for SMEs, giving them more, visibility also, because otherwise, big investors, they invest, the big asset managers, in big companies, but maybe they are those who need less, strong support in equity to rebound their debt, which increase the loan. Right. At the same time, on the other side, we need to increase access of investors. Yes.
Yeah, and I was going to ask you actually on that point, where do you stand on Spax? So Spax have gotten a bit of a bad reputation. How much do they help with some of the concerns, especially for SMEs that you're just talking about?
That's, Francine, a great question. And I can say also that IOSCO, the International Organization of Securities Commissions, we have also just, launched and organized a network on Spax. Everyone is discussing this. I can tell you, I hear there are a lot of pros and cons, there are myths, and there are, everything is there. We have an interesting experience in Italy. 10 years of Spax. Okay, we are, I would say, middle-sized market. So we had nearly 40 Spax in the last 10 years. I think a Spax, in our experience, has been a way to give easier, to give finance to SMEs, especially growth company, to give also, and in a sense, oblige them to more transparency, but also to give the access to investors, both institutional and retail, both directly and indirectly, to SME financing. There are big issues of investor protection, of transparency, of disclosure, but I think we should be careful not to throw, the baby with dirty water. Spax are an answer to a need of having a more proportionate approach to SMEs entering the market. So I think it's important to analyze it, and then we'll see.
Thank you so much for joining us today. Consub Commissioner Danae joining us this morning. Now, coming up, senators head to vote on Biden's infrastructure bill. We'll discuss the proposed amendments and potential setbacks. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, senators are prepared to place a stamp of approval on Biden's $550 billion infrastructure package as they head to vote later today. The process could drag on late into the night, with Republicans set to propose multiple amendments. But the Democrats are also expected to secure the necessary majority. Well, we're joined now by Bloomberg's Kathleen Hunter. Kathleen, great to have you on the program. So what's next in the Senate today?
Well, we're looking at a vote mid-morning D.C. time. That would be final passage of the legislation. And then from there, senators are going to turn to their budget blueprint. That's the $3.5 trillion proposal that wraps up the rest of Biden's economic agenda. They're likely to pass that perhaps tomorrow or the next day, and then the senators are going to leave town for their August recess. And that sets up a big showdown with Republicans and also with the House when they return from their recess in September. Nancy Pelosi in the House has said that the that her chamber isn't going to take up that legislation, the bipartisan infrastructure legislation, until the Senate delivers on the rest of the Biden agenda. And so that's going to have to get sorted out. Nancy Pelosi, much like in the Senate, has a very slim majority in the House. She can only lose 3 of her Democrats. And also there's a debt limit fight brewing that could come down to a vote in late September. And so there's a lot of fiscal issues that are going to need to be worked out in the coming weeks. And so today is obviously a big step in the right direction for the Biden agenda, but it's not the end of the road by any stretch.
Kathleen, thank you so much for the great roundup. And of course, Kathleen Hunter will be covering this for us today and over the next couple of days as well. Now, to talk more about the infrastructure bill, we're joined by OMFIF's chief economist, Danae Kyriakopoulou. Thank you so much, Danae, for joining us. When you look at the infrastructure bill, and I guess, some of the things that, for example, weren't accepting in cryptocurrency, I guess what the market wants to know and what economists wants to know is that does it really generate inflation that's not transitory? How do you view this infrastructure bill?
Hi, Francine. Good morning. It's great to be on the program. I think when we look at the crisis that we've just been through, the big question was what kind of growth are we going to have going out of the crisis? Because we faced the double question of generating a recovery and also not going back to the old system of generating a consumption-led recovery that would generate higher inflation and also go back to the same economic model that we had before. I think the awareness around the issues that we're facing, such as climate change, the need for infrastructure investment, the need for an infrastructure-led recovery is really clear. And this infrastructure bill is showing that we're going for a model of growth that is different to the recovery that we saw from the previous crisis. So I wouldn't worry as much about inflation as if we had a consumption-led recovery as a priority, even though, of course, it is fiscal spending. We will see higher inflation than we would have otherwise. But I think ultimately growth is going to be very high, and that's the good kind of inflation that we want to have.
Danae, is this on people getting vaccinated, or do you worry about the Delta variant? What does the Delta variant actually mean in terms of recovery right now?
I think it shows that we're not really out of the woods yet, as we would have thought a few months ago. It's showing that the coronavirus crisis is something that economists cannot predict and no one, politicians cannot predict. So we thought we would have been out by now, and we're not. So it is worrying in terms of the recovery that we have to continue with some of the measures. But most governments are thinking now that the Delta variant is hitting people hard, but not at the same rate in terms of hospitalizations because of the rate of vaccinations. It's going to be less of a hit on the economy in terms of the measures that will be needed.
Danae, I know you've also done some great work, and actually your latest research focuses on why you think relying on the financial sector too much to deal with climate change could actually be a concern. I mean, yesterday we had this pretty explosive report from the UN saying, we need to do something now. It's like we're in red zone for the climate change. We keep on hearing about it, but where do you see the biggest changes coming from?
Yes, the IPCC report was really concerning. It's putting more certainty around what are the kind of range that we are going to see in terms of temperature increases. We still have time, but the window of opportunity is very short. And I think so far the regulation that we've seen has gone mostly through the financial system and is starting to reach its limits. Yes, you can address climate change by directing the flow of funds to greener projects and away from dirtier projects and sectors, but you also need to start regulating directly the real economy through carbon taxes and through other measures. And the EU's Fit for 55 plan and the climate action plan that we've seen is a step in the right direction, but we need to see more direct action and not relying too much on just the financial system, the central banks, the supervisors, the regulators to do their job. They are doing their job, but it's not enough.
But what's the read across between the real economy? What does the real economy actually need to do a step further?
So, for example, a carbon tax to create incentives for industries to face the costs of pollution, as opposed to saying a loan for a dirtier project is going to be more expensive by going indirectly through the banks to make the cost of funding higher for these projects. A direct intervention would be a tax or a subsidy for dirty and green projects, respectively.
Is Europe still leading the charge? I mean, in 2020, we had this, the Green Recovery Plan that was meant to kind of spearhead some of the climate change efforts. Do you see that, waning, or is it still being the case?
Europe has had a head start, but the US is catching up very, very fast. When I speak to regulators and central bankers in Europe, they're saying, well, we're getting all these calls from our American counterparts every day to hear from us what they should be doing and what regulations we're putting in place. And we think that in a few years' time, we will be calling them because they are going so fast and they will be so far ahead. But it's not a competition. Everyone needs to do their part, and there is a lot of cooperation. And I think the Network for Greening the Financial System is a good example of that. And we, of course, should not forget the responsibility of developed economies such as Europe and the US to also support the transition of developing economies who do not have the same resources to do the same and have not enjoyed the level of development without a concern for the environment as Europe and the US have done.
Danae, thank you so much for joining us. Danae Kyriakopoulou, their OMFIF's chief economist, talking about a wide range of subjects. Now, coming up, JPMorgan boosts pay for more staff, raising the stakes in Wall Street's battle for talent. That story is up next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, JPMorgan has raised the stakes in Wall Street's intensifying battle for talent. It's expanding a previously announced pay increase to a broad range of staff as rivals across the industry pay up to hold on to junior staff. Well, joining us now is Bloomberg finance reporter Tom Metcalf. Tom, great to speak to you again. It feels like every day we get you on to talk about which bank or which broker is paying their staff more. So how long-term will this reversal actually, how many more companies are we expecting to pay staff more?
Yeah, I think it's going to be across the industry. And the interesting question there is, who is this sustainable for? These are big rises. Jefferies yesterday put, I think, their baseline pay for first-year analysts in the US up 29% to $110,000. So it's just whether can maybe some of the smaller firms keep up. This whole global battle for talent, where does it end?
Where does it end? Is there a consistent, global picture across finance for either people working from home and coming a couple of days into the office or just being paid more?
Yeah, so on the being paid more, that was interesting. A lot of the messaging from the firms we talked to has made it very clear this is for sort of US analysts, so particularly folk in New York. Now, you're also seeing that kind of spread around the world. It won't be an easy conversation if, perhaps your intern in Hong Kong or your first year in Hong Kong is wondering why they might be getting paid less. So I suspect it will spread globally on the pay front. But on the work from home front, that is definitely sort of market by market, region by region, in some cases city by city. So there's no clear picture there yet.
How does it work, Tom, through all of your reporting and editing? Do pay rises also tally with work from home, or actually are chief executives saying, well, if you work from home, we'll have to pay you less because there's no commute, for example?
Yeah, it's really the second point there. That's been the most entertaining part of this is CEOs, they're all about trying to retain talent, but at the same time they're going, hey, we're not the Muppets here, right? We will be demanding, a lot for this money. So I suspect, particularly if you're, in these banks raising pay, eventually, when, the government guidance allows, etc., most people will be back in the office.
Great. Thank you so much for joining us, our Bloomberg finance reporter and editor, Tom Metcalf. Now, we'll have plenty more on Bloomberg Surveillance Early Edition. Up next, I'll be joined by Danny Berger and Kailey Leinz. This is Bloomberg.
The Senate is now finally on the precipice of passing major bipartisan infrastructure legislation.
I know that we're going to get this bill done in the next 24 hours or so, and it's going to make a real difference for people in my home state who are looking at roads that are in deep need of repair, bridges that are past their useful life.
But the 50 Democratic senators, as well as the rest of the chamber, want to go on vacation. They want to get back to their districts this weekend. So there's a bit of time pressure to get this done. Schumer will get this done this week, and then, again, it goes over to the House where nothing much will happen.
This is Bloomberg Surveillance, early edition with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, August 10th. Our top stories today. Closing in on a vote, the U.S. Senate may pass that $550 billion infrastructure bill as soon as today. Taper timetable at the Fed. Will the central bank actually end asset purchases soon? Two Fed presidents say there are promising signs that the economy is getting to where it needs to be. And Cloudy Vision, SoftBank's Vision Fund, sees a sharp drop in profit thanks to declines in public holdings like Uber. Well, good morning, everyone. I'm Francine Lacqua here in London with Danae Berger, and Kailey Leinz is in New York. Matt Miller, another day off. Kailey, when you look at the markets, I was looking at some of the numbers. Incredible earnings season we've had so far. I think 185% earnings per share in Europe, and we're expecting like 130 or something like that. Then the focus is once again on central banks after we heard from two Fed presidents.
Yeah, you really haven't seen the market reaction you would expect when earnings are beating to such a wide degree, Francine. It actually has been quite quiet, maybe as markets await more clues from central banks like the Fed. In the Asian session, it was a bit mixed. You had stocks down in South Korea as well as Taiwan, but we were higher in Japan after the holiday, and both in China and Hong Kong, equities rose by a little more than 1%. One individual story I was watching in the Asian session was in Japan with SoftBank. The shares did end the day higher by about 0.9% after reporting results, even though the Vision Fund reported its worst quarter in about a year. Some of those bets, like on Groupon, not really paying off for the Vision Fund, but the stock didn't get punished as a result. In foreign exchange, I'm paying attention to two currency pairs, one being the Japanese yen, the big underperformer in the G10 space, weaker against the dollar by about 0.2%. We're sitting at 110.47, but your biggest underperformer in Asia is the South Korean won. A lot of concerns about the way the vaccine rollout is going in that country, and as a result, it is weaker against the green by about 0.5%. Here in the U.S., really not a lot of action in the futures market after a relatively muted day for the equity market yesterday. Once again, it looks like it may be that way come the opening bell in about 4.5 hours' time. We essentially go nowhere on S&P 500 futures at the moment. We're trading right around 44.25 and going nowhere in the bond market either. The 10-year yield basically steady at 1.32%. And where you're seeing a little bit more action, as with yesterday, is the commodity complex. Crude trying to rebound from 2 days of losses, tallying up about 4%. Today, though, rebounding about 2%. We're trading at $67.90 a barrel on WTI. And gold has been lower for 3 days, Danny, but attempting a little bit of a rebound of its own. It's up by about 0.25%, Danny.
Kailey, we have some breaking lines just crossing the terminal on the Germany ZEW index, or ZEW if you are there on the continent. The survey, this is a financial professional, is dropping for a third consecutive month and missing expectations. So this is where they see the economy going, falling to 40.4. The estimate was for 55. Last month was above 63. So that is a very sharp decline. Now, in terms of impact on the equity markets, not having too much at this very moment. We are fractionally higher on most of the continent. Italy, the outperformer for the second day in a row. But we are seeing some weakness there on the FTSE 100. A lot of that has to do with some pound strength, that FX picture always impacting the island. Now, we are seeing the broad index up about 0.2%. Francine was mentioning this, really strong earnings. So this is another record high on the stock 600. The gains keep on coming. Now, we're looking at a euro dollar a little bit lower, 117.28, mostly dictated on that strength from the greenback after the Fed speak, and a bund, which is moving a little bit higher. However, giving up some of those yields, giving up some of the traction higher after that ZEW index. And finally, Francine, I want to point out what travel and leisure is doing here. It is the best performing sector today. A lot of that has to do with the renewed confidence, considering the EU will indeed allow U.S. travelers in. I know that wasn't an issue for you when you went to Italy, but, you know, for tourism, this is important that they can get people like Kailey over onto the continent.
Actually, and there's this great, our big take today is wonderful. So it's basically a travel, you know, it's an interactive travel map. So you go on the Bloomberg terminal, you find it, and then you say, right, I'm Kailey Leinz, I want to travel from New York to London. And they say whether it's easy, what you need, and the percentage of people vaccinated in London, for example. And you can do it from anywhere in the world.
Francine, I love how you and I are just planning out Kailey's holidays now. I think she needs to pay us a little something for that.
My personal travel agents.
A honeymoon in London, Kailey. I bet you didn't think of that. Now, look, at what else is ahead today. The U.S. Senate is set to vote on the $550 billion infrastructure proposal later this morning. 10 a.m. New York time, Cleveland Fed President Loretta Mester discusses inflation risks at a virtual event, and then we'll get earnings from the largest U.S. cryptocurrency exchange, Coinbase. That's at 4 p.m. So senators expected to approve the $550 billion infrastructure package in a vote later today. The process could drag on late into the night. Well, for an update, let's get straight to our Joe Matthew, a Bloomberg Washington correspondent who joins us from D.C. Joe, look, we were expecting a vote maybe yesterday. It could come this morning, but what are the main sticking points?
It looks like it's going to happen late this morning, and we're pretty much beyond sticking points. I mean, this is a bill that looks like it will actually pass the United States Senate at last after months of negotiating with bipartisan support based on some of the procedural votes we've seen. You could have 17, 18 Republicans voting in favor of this bill. That's the hard infrastructure bill, as we call it. Then comes part two, and that's the soft infrastructure, the human infrastructure bill that would go through reconciliation. All of this is going to happen today, likely in the Senate. When the bipartisan bill gets the vote, likely passes and heads toward the House, Chuck Schumer, the majority leader, will move immediately to this reconciliation matter. We're talking about $3.5 trillion of spending, and it's still unclear exactly what form that will take in the end.
Well, you talked about the House there, Joe. Where does Nancy Pelosi and her coalition stand in all of this, considering Pelosi says, hey, you have to pass the $3.5 trillion before we're going to do anything on the bipartisan effort?
Now, that's the real question to be asking this morning, and she has not budged on that. In fact, she went so far as to say there ain't, and stress the word ain't, going to be no bipartisan bill, she said, without reconciliation. That's why you're going to see the Senate move very quickly here, and it's why we're not likely to see any action in the House until September, unless they come back early in August. And as we were just hearing at the top of the program here, lawmakers want to go home. They want to go on vacation. They want to have their town hall meetings with constituents. They want to see their families just like anybody else, and that seems to be the big motivator at the moment in the Senate for getting out of town.
And now with the new Bloomberg Big Take, they can use that tool to plan their vacation like all of us here, too. Joe, thanks so much. That's Bloomberg's Joe Matthew. And you can listen to Joe every day on his radio program, Sound On. That's at 5 p.m. Eastern Time on Bloomberg Radio. Now to SoftBank, which reported a sharp drop at its Vision Fund in its profit as the value of investments in public holdings like Uber and Coupang declined. The investment unit posted its worst performance in a year. Let's get more on this with Bloomberg's Giles Turner. So, Giles, what was it? Something like 90% in terms of profit decline at Vision Fund. What led those losses?
Well, it hasn't had a very good quarter, really, for the Vision Fund. I think it's lowest since the first quarter of 2020, fiscal quarter, that is. But I don't think we should get too distracted by this. I mean, the reason why the shares really haven't moved much today is because you can really see what SoftBank is doing, because so much of its investments are listed. It's got its huge stake in Alibaba, for example, and lots of other telco company holdings. So I wouldn't get too worried about the Vision Fund. It goes up. Last quarter, it was a stellar quarter, the quarter before last. Now it's not quite so bad. You've got to think about what's going to happen next quarter because of the nightmare for SoftBank that's going on in China right now. Yeah. Alibaba's stake is going down, for example, and a lot of its other holdings are in real trouble.
Giles, is SoftBank actually a flashing warning on tech stocks? Because we saw that the company no longer lists Facebook, Microsoft, Alphabet, or Netflix amongst its investments in this last earnings statement.
I wouldn't read too much into that either. I think that a lot of those early investments in the tech stocks were an idea of master at the time. We've understand it's fallen out of favour, for example, and it's diversifying its public holding investments. We broke the story a few weeks ago. It's got this big stake in Roche, the pharma company, and that might see that be made public in the next quarter, for example. It'll be interesting to see how far it pushes its pharma investments and biotech investments and away from some of these older tech stocks. But also, it's still got this $5.6 billion holding in Amazon, for example. So I wouldn't say, it's exiting completely. It's just maybe picking and choosing a bit more.
All right. Thank you so much for that breakdown. Joining us there is Bloomberg's Giles Turner. Meanwhile, JPMorgan has boosted the pay for more of its staff. This is as rivals across the industry try to hold on to their lowest level analysts. Let's get more on this with Marcus Ashworth, Bloomberg opinion columnist. Marcus, the race to the top continues. What's going to stop it?
Well, it's been a banner few quarters, really. The last year or so for Wall Street has been huge. The guys at the top, I'm sure, are not restricting their own compensation. So, funny enough, it goes down the food chain, and we're starting to see not just the graduate intake, first-year analysts, I think, in Wall Street speak, but the second and third-year analysts starting to get paid quite a bit more. Now, this could just be they're taking from potential bonuses and paying more fixed compensation. They're probably doing a bit of that, but at the same time, if things continue well, then of course bonuses will rise at the same time. This is simple competition. It's interesting to see this being done the capitalist way on Wall Street, whereas in Europe, perhaps it's done more by regulation, whereby with bonus caps, people are forced to pay more on the fixed salary. But look, this is going to carry on. It's what capitalism is all about. And these guys will be worked hard for it, and they will probably deserve the pay. It's just they're not going to be the different people being attracted from outside.
Marcus.
I still think venture capital and other exciting tech things will lead other people away from Wall Street.
On that note, we have Perella Weinberg, one of the many firms starting to look at delaying the return to office. Can these firms justify paying people a higher salary when they're still not coming into the office and working from their kitchen table?
Oh, most certainly, yeah. I think the beauty of the Excel spreadsheet and interconnectivity has shown that, thankfully, we have the technology to be able to handle most service jobs without physical presence for an extended period of times, and we should be thankful of that. If this pandemic had hit 10, even 5 years ago, I don't think we would have been in anywhere near be able to recover. Nonetheless, it's just very scary to see that the Wall Street mantra of get back to work, get back on the office, get to see your clients is being hampered by this Delta spread, and that is very sad to see.
Yeah.
Because really, I worry about the Wall Street effect into New York City and of course the city and the City of London as well.
Yeah, that's a very fair point. Marcus Ashworth, Bloomberg opinion columnist, thank you so much. I want to get back to the markets now and take a quick check on some stocks moving in pre-market trading here in the U.S. And for AMC, we actually have some fundamentals we are trading on. I don't know if I say that very often, but it did report earnings after the bell yesterday, reported a narrower loss than expected. It also said that maybe it's going to start accepting Bitcoin at the theater chain by the end of this year. So that stock is up about 9.25% in early hours. Another stock moving to the upside is Arcturus Therapeutics. Wow, making up words here on this Tuesday morning. Arcturus Therapeutics said overnight that it is selected for inclusion in a phase 3 vaccine trial against COVID-19. So that stock up a whopping 37% before the bell. Not so lucky for Tesla, though. We just got delivery data out of China, and its China-made deliveries were down 69% in July. The stock is not down quite that much, but still lower by about 1% before the bell, Francine.
Yeah, Tesla, I mean, it's not moving actually that much. 69% decrease month on month, you would think would lead to a sharper fall in pre-market. Coming up, Hugh Gimber, JPMorgan Asset Management Global Market Strategist. We'll talk about earnings. We'll talk about the Fed. This is Bloomberg.
Well, I think that the risk of a tantrum this time is less because people understand the game plan. First, we taper, then we raise short-term rates, and then we start to let the balance sheet of the Fed shrink.
Former New York Fed President Bill Dudley there speaking to Bloomberg, and we've had a lot of Fed talk over the past few days. A lot of that has been on commentary around the jobs market and the strength therein of. And I want to dive into exactly how strong this jobs data has been. And I want to welcome our listeners on radio as well. I have a chart here, which I know you can't see, but I will explain it to you. I'm looking at yesterday's JOLTS figure. So this is of job openings versus Friday, some of the unemployment data we got. And I have to say, I took this chart from Tom Porcelli over at RBC, always the sober voice when it comes to the macroeconomic picture. And what's happened so far over the past couple months is if you look at what's happening to job openings in the blue, they have surpassed that of the unemployment rate easily. So again, for our radio audience, this essentially means on this chart that there are more job openings than there are unemployed. Tom Porcelli says, look, that this is a really tight labor market. This only happens a few times in history. Last time it happened was right before the pandemic, essentially saying, look, we've gotten pretty much back to normal and where we were pre-pandemic. So what is the impact this might have on markets and where the Fed might go? Let's bring in our Bloomberg MLive strategist, Eddie Vanderwaal, who joins us now. So, Eddie, I'm not going to make you look into your crystal ball of when the Fed is actually going to taper, but I will just say, given this data, given we're also hearing from Mester again today, how much is this market moving around Fed speak?
Yeah, I think that's a really good question. So we saw that last week, right, with the other jobs numbers, and not even the NFPs, with the ADP. ADP absolutely disappointed. And what did we see? We saw gold prices rally. We saw the treasuries react. But what happened? Clarida came out, and Clarida said, well, actually, the economy is quite strong. And everything erased. So basically what that told me was that the market cares more about the Fed's reaction function than it does about any one data point. So I think, tapering is the name of the game. And I think when we do see that, I think we could really see reverberations across markets.
Eddie, commodity markets, gold, oil, were actually on the move yesterday. Does it suggest that if we have a taper tantrum because of the Fed, it will be wider than just bond markets?
Yeah, Francine, I think so. I think right now, right at this moment in time, I think so much of our asset prices broadly are predicated on where Fed policy is, on loose money, right? With the amount of day trading that we're seeing, with the stock valuations, with all of that is predicated on really low interest rate. So once we start seeing tapering and we see a move towards higher rates generally, I think that could be, a significant event for the stock market. Now, if we look back at 2013, we didn't see taper tantrum hit the stock market. It was really a bond market event. But I think this time could be different.
But speaking of the bond market, Eddie, we're starting to see strategists re-rate lower their year-end forecast for 10-year Treasury yields. Goldman down from 1.9% to 1.6%. JPMorgan now down at 1.75%. But that's still 40 basis points or so north of where we are today. Is it just the Fed that provides that upside?
Yeah, I absolutely. I think you're right. I mean, it is about the Fed, and I think people are accepting that the Fed's going to taper, but it is not. It's. I think the message there is that the Fed's going to taper, perhaps sooner than expected, but not as aggressively as expected, right? I think that might be the message here. I think the Fed will want to do this gradually, not to spook people, and I think that's what the markets are telling us, and that's what the analysts are telling us. Whether that is right remains to be seen. I think there's quite a lot of events coming to the end of the year, and a lot of jobs figures to come in before we really get to see whether the Fed is pulling this off.
Eddie, the market so far has also shown us basically that, you buy equities on the dip and you'll be fine. Are stocks immune to this kind of volatility?
Well, we're seeing record high after record high, right? Again, today in the Stoxx 600, we're seeing those record highs. And every time we get a pullback, it is not a very big pullback, and we see money flowing in. With that JOLTS figure, for me, is really interesting in this context, because I think, a lot of this is because we are seeing retail investors who are at home. We've got the amount of day traders, I think, sitting at record highs, something like a fifth of the market that currently allegedly is day traders. Now, when people start going back full time to work, the question is whether we start seeing them, perhaps less retail activity in the stock market. So I think that these two things are not unrelated.
Eddie, thank you so much for the market wisdom. As always, Eddie Vanderwaal there from our MLive team. We'll have plenty more on the markets, the Fed, and earnings. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Francine Lacqua and Danae Berger in London. Now let's get the first word news. And in China, the central bank is fanning expectations of further monetary easing. The People's Bank of China says in its latest quarterly report that inflation pressures are controllable. At the same time, the bank highlighted risks to the economic growth outlook. Meanwhile, state-run media cited economists calling for interest rate cuts. The U.S. coronavirus wave that started in low vaccination states in the Ozarks and Deep South has now engulfed the country. Cases and hospitalizations are at their highest since February. 38 states have transmission levels considered high by the CDC. The other 12 states and Washington, D.C. have transmission rates in the second worst category. The U.S. is preparing to send coronavirus vaccines to Mexico in the coming days. Mexico is among the countries hardest hit by the pandemic, with almost 250,000 deaths. That's the fourth highest total. Bloomberg has learned that the U.S. will send Mexico vaccines from AstraZeneca and Moderna. And for the first time in decades, American workers are calling the shots. Companies such as Kroger, Under Armour, and Chipotle are pushing up hourly wages to try to retain employees. Others are offering hiring bonuses. The result is workers are scoring the biggest pay hike since the early 80s. Wages for the leisure and hospitality industry have risen at an annual rate of 6.6% in the last 2 years. And Francine, it really speaks to the chart Danae was showing all of us earlier, the jolts. 10 million job openings or more here in the U.S., which is more than unemployed people. So companies have to incentivize people to come in the door.
Yeah, it's amazing, actually. We also had a conversation with the Intercontinental chief executive, and he says he's struggling to fire staff, but the ones that he finds he needs to pay more. So it's a conversation, I feel, that will run and run. Coming up, we'll talk about maybe wage inflation with Hugh Gimber, JPMorgan Asset Management Global Market Strategist. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danae Berger in London. Kailey Leinz is in New York. Matt Miller off today. Now, Kailey, if you look at the markets, and you put it beautifully at the beginning of the hour, which is we have some earnings results that is actually coming in better than expected, but it's not moving stocks that much because there are a number of other factors kind of getting in the way.
Yeah, that's totally right, Francine. I would say it's moving stocks in Europe maybe a bit more than here in the U.S., although European earnings growth has actually been quite a good deal better, Danae.
Yeah, definitely. I mean, look, we are at all-time highs on these market, Francines. As you say, a lot of that fueled by earnings optimists. I mean, Fed speakers who? Let's keep seeing these good numbers when it comes to profit beats.
Now, what's your terminal? I mean, this is one of the things that, I love when we show a good terminal to actually look at some of the stocks we're watching.
Yeah, exactly. Well, Fran, I will have a terminal in just a little bit about how risks are being maybe not exactly calculated correctly. But in the meantime, Kailey, what's going on in markets there?
Well, better in Europe than here in the U.S., Danae. The Stoxx 600 actually is at a fresh record high. Not a huge move to the upside today, but still up 0.2%, and that is enough. And actually, if it closes in the green, it will be the 7th day in a row that it has done so. Here in the U.S., though, really it's pretty quiet out there. Futures go nowhere on S&P E-minis. We're down just 0.5 point, and going nowhere in the bond market either. We're unchanged on the U.S. 10-year Treasury yield, sitting right around 1.32%. More action in the commodity complex. WTI crude has fallen about 4% in the 2 sessions prior to today, but attempting to stage a little bit of a recovery. It's up about 1.3% when it comes to futures, trading at $67.31 a barrel. Also, we have a lot of action in pre-market trading this morning. A lot of stocks moving on the back of earnings beats. One of them being AMC, of course, the theater chain, the ultimate meme stock, or at least one of the original ones. It actually posted more positive fundamentals than analysts expected, a narrower loss than they were looking for. It also may accept Bitcoin by the end of the year. That stock's up the better part of 10% in early hours. You also have Callaway Golf, Digital Turbine, each moving higher off of their results, up 6% and 5% respectively. And 3D Systems also beating expectations. It's up about 10.5%. So, Danae, now let's get that terminal.
Wait, hang on, Kailey. Is that all green on your pre-market movers?
I know.
I mean, what a great day. Thank you. Thank you for that. All right. Now I'm in a good mood. So, yeah, let's get to this chart. So I was talking before about this idea of how we judge risks, specifically growth risk. And I also want to welcome our radio listeners as well, who I know you can't see this chart, but let me describe it to you. I am looking here at a chart provided by Morgan Stanley and essentially tracks the 10-year yield versus the outperformance or underperformance of industrial metals versus precious metals. Now, usually you can see this relationship is very closely tied. But again, for the benefit of our radio listeners, the relationship between yields and industrial metals has broken off so far this year. So what does this mean? This means don't make too much of the decline in 10-year yields, according to Morgan Stanley, that the link here between actual growth and where we see those yields has been broken by emergency pandemic relief from the Fed, from governments. So they say when we start to see some normalization in policy, expect this relationship to come back together, Fran.
Yeah, love that chart. So let's look at what metals and the 10-year actually mean for the future. Joining us now is Hugh Gimber. Let's get straight to Hugh to talk about the markets and to talk also about what we heard from the Fed and future market expectations. He's global market strategist at JPMorgan Asset Management. Hugh, Difficult question. What do you think is most mispriced in the markets right now?
Good morning. I think for me, you have to look at the bond market because clearly we rocketed up towards 175 on 10-year treasuries at the start of the year. And then that move has completely washed out over the past couple of months. And so when I looked at 10-year real yields around -1%, that to me is just inconsistent with the strength of the economic outlook today. And I think the chart that you've just showed makes that case very clearly. You see it in metals, you also see it in the stock market, you see it in some emerging market FX. There are many parts of the market today telling you that this is a recovery that has legs, that's not going to be derailed, and yet the bond market just doesn't match up to that. So I think the question now is, where is the catalyst for treasury yields to reprice? And to me, you're looking to the labour market. You've seen strong data last week.
Hugh, are you expecting actually a tapering in the fall from the Fed?
I am, yes. I think they're getting enough signs now that they can be confident to reduce asset purchases. So you've seen it in the data, and I think you've seen a subtle shift in tone as well, particularly with their communication around inflation, where there are now some concerns, I think, building, not that we're looking at a disorderly inflation picture, but one that could be quite stubborn and sticky above the Fed's target. So with that, yes, I think you are looking at tapering communication to come in the fall, and that move to start towards the end of the year.
Is yields moving higher off the back of the Fed tapering or labor market data or otherwise necessary to get a renewed cyclical rotation, Hugh?
For me, yes. I think that trade has been very, very clearly linked to the bond market so far this year. Equity market leadership is being driven by 10-year yields. And so in that base case where you see yields pushing higher as we move towards the end of 2021, I do think that there's another leg to come for that cyclicals versus defensives trade, and really the reflation trade more broadly, where we've seen that leveling out over the past couple of months. But again, I feel that that is inconsistent with the strength of the economic recovery ahead.
Would you say that the moves we've gotten off the back of earnings results have been inconsistent with how stellar earnings have been?
So I absolutely agree with you that earnings season has been incredibly strong, and that's despite a fairly high hurdle heading into Q2 earnings season. For me, the answer as to why we've not seen markets really move is because the multiples have already priced in a lot of that good news. So I think you can take a lot of positives from what we've heard from companies over the past few weeks. And it's not too much of a concern to me that you're not seeing those earnings beats really being rewarded. Personally, I think of this as, frankly, the market growing in to multiples that were already reflecting in much of this recovery.
In that case, Hugh, how do you justify holding equities if all of the good news is already priced in?
So I think you need to split out here the earnings outlook versus the valuation outlook. Because for me, I think multiples at current levels can be held. You can justify pretty pricey stock markets, but I still think that there's room for earnings to be upgraded, particularly as you look to Q3 and Q4 estimates that are pretty much at or even below current levels of EPS. I think this is an earnings recovery.
Yeah. Well, I mean, on that note, Hugh, does that mean you don't buy this peak earnings narrative that started to emerge?
No, I don't, frankly. I don't buy the peak earnings narrative. I don't buy the peak growth narrative overall. Really, I think people are misreading what is not a rollover in growth, but rather a shift back to still very, very strong levels of activity and strong levels of corporate earnings. So I think in this environment, clearly there has been enough of concern around the Delta variant to justify people focusing on downside risks over the past 4 to 6 weeks. But I'd expect those to fade as we move through the second half of the year. And really investors to refocus on the fact that even if the rate of growth is not quite as strong as we had in Q2, this is still a very robust outlook.
But Hugh, isn't the base actually, shouldn't it go back to 2019? So you're extremely bullish on the markets from here on end. What would, in your eyes, actually warrant a market correction?
Yeah, I'd say I'm bullish on the markets, particularly in those areas which still have room for catch-up. So this is more about a catch-up from cyclicals towards the market leaders of 2020, rather than a narrative that just the whole index can surge higher from here. In terms of the correction, I think we know the Delta variant is still an unknown. This is a risk that's going to be with us for some time, that no one really can predict the full path of COVID-19. But even then, I think you look at the underpinnings of this recovery, still with accommodative central bank support, even if that's being gradually withdrawn, and still with a very, very healthy consumer that has firepower to drive above trend growth for multiple quarters.
Hugh, we talked about all the good news on earnings being priced in, but what about when it comes to fiscal policy? We are getting very close, within hours potentially, on passage of a $550 billion bipartisan infrastructure package in the Senate. Another $3.5 trillion could be pushed through later. Is all of that priced into this market?
I'm not convinced that it is, personally. I think the infrastructure bill that's going through at the moment really has to be thought of as a stepping stone. Because when you look at the numbers, it's not going to materially change the deficit, for example, over the next couple of years. Where I think we should be focusing much, much more is on the prospects for a larger fiscal stimulus bill to come via reconciliation in the autumn. And I think there, you look back to what happened earlier in the year. People said Biden cannot get his stimulus bill through. And yet, in the end, what he got was pretty close to what he wanted. This time round, clearly some compromises are going to have to be made, but I'd still expect that you're looking at a very robust package of spending measures to come through in the autumn via reconciliation. And I don't think when you look at the market today, that's been fully baked in.
Hugh, thank you. Hugh Gimber, there, global market strategist at JPMorgan Asset Management. And of course, we also need to link cryptocurrency with the infrastructure bill, because coming up next, seeking a crypto compromise, we'll hear from Jesse Powell, the chief executive of Kraken, as the cryptocurrency industry makes itself known in the halls of Congress. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later on today, Governor Mike Dunleavy, the Republican from Alaska, joins Balance of Power at 12:30 p.m. Eastern Time. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danae Berger here in London, Kailey Leinz in New York. Now, the U.S. infrastructure bill's possible tax rules have left crypto firms worrying as they await a vote. Earlier today, we spoke with Jesse Powell, the chief executive of the digital currency exchange Kraken, Europe's largest crypto exchange by volume and the world's fourth largest.
This bill, as written without the amendment, absolutely stifles innovation. I mean, it's effectively like saying every time you load a web page, you have to collect all of the personal information of the person visiting your website. It's totally insane, and it cannot be complied with as it's written. It just completely misunderstands the way the technology works. Obviously, decentralized protocols do not have a process to collect personal identifying information from people, or even have any way of knowing who the users are. So, it's a square peg in a round hole, and it's just kind of mind-blowing that at this point, 10 years on, the people in government would still have absolutely no idea what they're doing here, and without having any stakeholder engagement on this, would try to slide this into a must-pass massive infrastructure bill, sort of a backdoor regulatory effort. It's just kind of shocking, and I think
Jesse,
makes everyone question the lawmaking process.
Yeah, but do you think they're just trying to make it safer? So even if it's impractical and actually impossible because you don't have the data, do you think it comes from a point of not trusting cryptocurrency or Bitcoin and just try to make sure that they have as much data as possible to understand who's investing and how much?
I don't think it's about that. That kind of information is already available through the exchanges. We're regularly providing data to the U.S. regulators and to the IRS. And the stated purpose of this piece of the bill is to collect additional tax revenue. They believe that there are people out there engaged with cryptocurrencies that are not paying their taxes properly. And our view is that that's a very small piece of of the cryptocurrency user base. Obviously, anything that you do through Kraken is easily reported to the IRS. Your transactions live on the blockchain for all time. And the IRS is actually very good at looking at the blockchain to see what's going on there. So I don't think it's about consumer protection. They say this is more about tax collection and paying for the infrastructure expenditures that are in this bill.
If you look at the sell-off in Bitcoin, it does seem to have been more subdued than the past. Do you feel like cryptocurrencies is, I guess at the margin stabilizing? Is it becoming something that will, I don't know if it will plateau, but will just become up or down, but within ranges?
Yeah, we've seen historically Bitcoin move in these 4-year cycles. And, every time it pops up 10x from where it was before. This cycle, if you look at the chart historically, we could easily go up to $400,000 a coin this cycle before we get to the next Bitcoin halving. So I think it will trade within a range for a while. We got up to $60,000. We went back down to 30. We're now hovering on 46. This is, just kind of par for the course if you look historically at the chart and these cycles. So, I'm still very bullish on the price. I still think we could see hundreds of thousands of dollars a coin in the next 12 months.
That was the Kraken chief executive, Jesse Powell, with a hot take, of course, on what we saw in the Senate yesterday. What I find absolutely fascinating, Danae and Kailey, is, and it's things that actually I didn't know, the crypto lobbyists made some 40,000 calls to senators in, I think, the past year. And it's actually amazing when you look at defense lobbyists and things like that, how much these crypto lobbyists have done so far, but actually failed unless we get a favorable vote.
Yeah. To that point, I kind of wonder if in some way this defeat for the lobbyists almost is a good thing for cryptocurrency in that it forces them to become more mature because they say, look, we didn't have enough money, enough power behind our lobby. So, Kailey, maybe this kind of allows the industry to become more mature and have that Washington firepower.
Yeah, it may become more organized, Danny, but I think there's an interesting point here about how mainstream or not cryptocurrencies are, because a lot of other lobbies, when it comes to healthcare, other industries that affect a great deal of people, they're just easier for lawmakers potentially to understand or feel that there is a great influence for those industries among their constituents. And while Bitcoin enthusiasts are indeed enthusiastic, that doesn't mean that there are a lot of them out there, or as many of them that are affected by other policies that lawmakers have to deal with, Francine.
Yeah, in the end, it was Alabama that said no, so we'll see if that changes in the vote today. Coming up on Bloomberg Technology, an exclusive conversation with the Coinbase president and COO, Emily Choi. That's at 5 p.m. in New York, 10 p.m. in London, and this is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danny Berger in London, Kailey Leinz in New York. Now let's also join Tom Keene, co-anchor of Bloomberg Surveillance, who joins us with another great chart. Tom, I don't know whether you're looking at Fed speakers today or real yields.
I'm looking more at the stock market. I think today's a really important day, Francine. Within the data, there's all sorts of nudges here to a great new bull outlook, starting with a strong dollar, the DXY above 93. Where's the optimism come from? It comes from and continues to come from the jobs report. And as Tom Purcelli at RBC Capital Markets notes, the JOLTS report, Michael McKee's favorite report yesterday, was the same way. What we've got here is a labor participation of the core audience and the jump condition. I kept the previous circle, and the new circle, Francine, nicely shows the jump condition in labor participation off this bang-up report.
That's on the labor side, which is one part of the dual mandate, Tom. On the other side, inflation. How important is CPI and PPI going to be this week?
It's going to be hugely important, Kailey, and what's important is there's a lot of other ways to measure inflation. The CPI is the media headlines and all that. There's core, there's the headline CPI, but there's all sorts of sub-indices which really add a lot of value. Everybody's got their favorite. I happen to like the Cleveland Median Core Index, been around for decades, but there's many others, and they all indicate it's incredibly lumpy, incredibly nuanced, and incredibly open to interpretation.
Tom, does all that positive data mean that when it comes to this equity rally, which you're watching, I mean, what is it, 9 months without a 5% or more pullback? Do we finally love this bull market, Tom?
That's a really, really good question. I've sort of been thinking the same myself, and I really can't make it out. What I would suggest is we're seeing rising bull market estimates led by John Golub out 18 months, maybe it's 17 months out to S&P 5,000. Ben Laidler this morning with an exceptionally optimistic note from eToro. We'll feature that on the show here in about 10 minutes.
All right, Tom, thank you so much. Tom,
Sure.
Have you checked out this? There's this new interactive story, which I think is great, a big take, which basically tells you where you can travel and what destinations are sealed off. I feel like Tom Keene would have a field trip actually trying to figure out where his next holiday is. Have you looked at it?
I have glanced at it, and I can't. I talked to Pharaoh. Pharaoh tells me where to go. He knows all
which
this
is in the
stuff.
studio. Probably. All right. Tom, thank you so much. I know Kailey, Danny and I have been looking at it, and it's a great way of saying, you know, what I thought was particularly brilliant about this interactive map is that you have to ask yourself, what are they looking at? And it's the rate of vaccination to the country of destination, it's how you travel, and actually how freely you can access cafes, for example, and restaurants when you arrive.
Yeah, I know you and Danny just really want me to come visit London, Francine. That is why you are so interested in how easy it is to get there from New York.
Yeah, that. So we're looking at travel and how Kailey can get to London. We're also looking at infrastructure.
We are looking at infrastructure. The Senate will resume its session around 9:30 a.m. Eastern time. We could finally get a vote on that $550 billion package in just a few hours' time. Of course, that is the first major legislative test for Joe Biden's economic agenda. But of course, the second part of what the president wants is going to be in that separate $3.5 trillion budget resolution that Democrats will try to push through on a party line. That will come after the bipartisan vote. The Senate will consider it, but a vote on that could drag out even until tomorrow, Danny.
Well, Kailey, I'm watching more earnings to come. We have Coinbase later today. It's going to be interesting to see how they fared in the most previous quarter when Bitcoin dropped as much as 40%. What does that mean for their profit? They are above their IPO price, but look, it's been a really volatile listing for Coinbase. That's what I'm watching. Francine, I know you're watching Travel Curbs, and one thing that sticks out to me is that you're using the tool to look for cafes that are open. Is this how you travel, where you can get some espresso?
But what's actually amazing is that the rules in Italy, so if you sit in a terrace in Italy, you don't need a green pass, which basically shows that you've been vaccinated twice. If you sit in France, you do need it. So it's also amazing when you look at the European Union, how all of these rules are so different, and literally, you can walk over from one country to the other with completely different rules.
I feel like
now, the other
rules are
story I'm
different
watching.
everywhere.
Yeah, they are, but I guess it's even more present when they're basically almost the same country. The EU says it will not reimpose travel curbs on the US despite the COVID surges. And what's interesting is that this will be on the review of the list of countries being granted access to in 2 weeks. So in 2 weeks, the decision can change, but for the moment, no change. Coming up, Bloomberg Surveillance. Coming up ahead, we'll hear from the Nobel Prize-winning economist Esther Duflo and Sarah House of Wells Fargo. I know they'll talk about inflation, they'll talk about the markets, Tom with some great charts, also as we await more Fed speakers. And then a reminder, CPI in the U.S. is tomorrow. This is Bloomberg.